And inflation fears keep value in the leadership position. The heck with tech. CHERYL PATE is portfolio manager at Angel Oak Capital Advisors and a new face to CNBC. We welcome her. And Jill Carey-Hall is a senior U.S. equity strategist at Bank of America Securities. She's also head of U.S. small and mid-cap strategies. Ladies, welcome. I'm going to ask each of you on a scale of 1 to 10 to tell me, with 10 being highest, your inflation concerns over the next, let's say, 12 to 18 months. CHERYL, you get to go first.
I would put inflation concerns somewhat at the high single-digit range, 7, 8. And really, I think we are very bullish on the economic recovery. Rates are likely to move higher from here, given the magnitude of stimulus, the vaccination deployment. But it's not going to be a linear line. We are seeing some softer inflationary measures come out of things like core inflation, while we're also seeing signs of increasing inflation in areas like tech, hardware, and consumer staples. So I think the grind is higher. We definitely favor the value trade and financials specifically here, but it's not going to be a linear path. But by end of the year, we're going to be higher on the 10-year.
But before I go to Jill, let me get your sense of what higher inflation. Put a number on that. Is that 2.5%? Is it 3%? What is it?
I do think near term, we can go over 2%. Again, remember, we're looking for averages over 2% to even start thinking about moving to a higher short end, which we still think is a couple years out. But I think near term we could go over that 2% level modestly. How
about you, Jill? Where, on a scale of 1 to 10, where do you put your inflation worries? And if you would segue then into how those worries may affect the fact that your price target on the S&P is actually below where year-end is actually below where the S&P is trading right now.
Thanks for having me. So I think from an inflation perspective, we're definitely seeing signs of percolating inflation, but we're only looking for 1.7% on a core inflation basis this year. If you're looking at CPI, it is going to be above 2% based on what we're forecasting. But I think when you look at the market, there's signs when you look at stocks that are sensitive to inflation, to commodities, to wage inflation. When you put all these sources together, those stocks have been outperforming. And they're suggesting that we could continue to see inflation pressures rising. So I think for the market, 1 to 3% and CPI has kind of been the sweet spot for equities. And when you think about the sectors and the areas that you want to be in, we'd really be more cautious on labor-intensive parts of consumer, luxury retailers relative to discount areas that might be hit harder by rising wages relative to some of the more cyclical energy, industrial materials that could actually benefit.
Shepard Smith here. Thanks for watching CNBC on YouTube.